Welcome to the deep dive. Today we're zeroing in on variance analysis.
Right.
Think of it like, well, a tool for understanding why a company's financial results didn't quite match the plan.
Exactly. It's all about comparing those projections, the budget or standards, with what actually happened.
It helps you pinpoint what's working and, maybe more importantly, what isn't.
Yeah, find those areas for improvement, in operations, in sales, across the board.
And we're going to break down the different types. We'll look at production costs, sales figures.
Using some specific examples to see how they're calculated and what they really mean.
Our mission, pretty simple, demystify variance analysis. Give you a solid grasp of the basics.
Okay, let's get into it. Maybe start with standard costing. That's often the foundation.
Good idea. So standard costing is where businesses set up expected costs, right, for materials, labor.
And overhead, yeah. These are the benchmarks.
Then you compare actual costs.
Right.
And the variance is either good news or bad news.
Favorable if actual cost is less than standard, unfavorable if it's more. Simple as that, really.
Okay, let's take direct materials. There are usually two variances people talk about here.
Price and quantity or usage.
The price variance.
Yeah.
That tells you if you paid more or less than the standard price.
Correct. It's the actual quantity you bought, multiplied by the difference between the actual price and the standard price.
And the quantity variance.
That one focuses on efficiency. Did you use more or less material than you should have for the actual production?
How's that calculated?
Standard price times the difference between the actual quantity used and the standard quantity allowed for what you produced.
We have an example. Say you bought 200 units at $8, but the standard was $10.
Okay, so $2 cheaper per unit times 200 units. That's a $400 favorable price variance. Good purchasing.
But then, let's say the standard quantity allowed for production was 100 units, but you actually used 110.
Ah, okay. So you use 10 extra units, multiply that by the standard price of $10.
That's $100 unfavorable quantity variance.
Exactly. So you saved money on the price, but used a bit too much material. It shows you different things are happening.
Makes sense. And it's a similar idea for direct labor, right? Rate and efficiency.
Precisely. Direct labor rate variance compares the actual pay rate to the standard rate times the actual hours worked.
So did we pay our workers more or less per hour than planned?
Yep. And the direct labor efficiency variance looks at whether the work took more or fewer hours than the standard allowed for the output achieved.
That one uses the standard rate, though.
Yes. Standard rate times the difference between actual hours and standard hours allowed.
Our example shows 450 actual hours at 20 hour, but the standard was 15 hour and 500 standard hours.
Okay, $5 extra per hour times 450 hours. That's a $2,250 unfavorable rate variance. Ouch.
But wait, they only used 450 hours when 500 were allowed.
Right. So 50 fewer hours worked than standard. Multiply that by the standard rate of $15.
That's $750 favorable efficiency variance. They worked faster or more efficiently.
So again, a mixed bag. Higher wages, but quicker work. This is why you break it down.
Okay, now, overhead. This can get a bit more complex.
It can seem that way. You've got variable and fixed overhead. We often talk about overhead being underapplied or overapplied.
Underapplied means you didn't allocate enough cost to production, so that's unfavorable.
Correct. And overapplied is favorable. You allocated more than the actual cost.
For variable overhead, it's kind of like a labor, right? A rate variance and an efficiency variance.
Basically, yes. The VOH rate or spending variance looks at the actual variable overhead rate versus the standard rate times actual hours.
And VOH efficiency compares actual hours worked to the standard hours allowed for production using the standard VOH rate.
Exactly. Did we spend more per hour on variable items, and did we use the allocation base, like labor hours, efficiently?
And fixed overhead. That's different because it's fixed.
Right. So we look at the FOH budget variance, simply actual fixed costs versus budgeted fixed costs. Did we spend what we planned?
And the other one is the volume variance.
Yes, the FOH volume variance. This arises because we spread budgeted fixed costs over a planned number of units or hours if actual production differs.
The amount absorbed per unit changes.
Precisely. If you produce less than planned, you typically get an unfavorable volume variance because those fixed costs are spread thinner.
Let's look at Lucy Inc. quickly. Budgeted 4,000 widgets, made 3,800.
Fewer than planned. That already signals a potential unfavorable volume variance.
Their actual variable overhead rate was higher, $1.60 versus $1.50 standard.
So unfavorable VOH rate variance.
And they used more hours than standard allowed for the 3,800 units produced.
Unfavorable VOH efficiency variance, too, took longer per unit than planned.
But interestingly, their actual fixed overhead was lower than budgeted.
Ah, so that's a favorable FOH budget variance. They controlled fixed spending well.
But because they produced fewer units, 3 to 800 versus 4,000, they got that unfavorable volume variance we expected.
Right. So you see all these pieces moving in different directions. Even though the total overhead variance was slightly favorable for Lucy Inc., digging in shows specific issues and strengths.
It really does highlight the need to look beyond the total. Okay, quick shift to sales variances.
Also very important. Comparing actual sales revenue to budgeted revenue.
Yeah.
Two main ones here.
Sales price variance.
Actual quantity sold times the difference between actual selling price and standard selling price. Did we get the price we expected?
And sales volume variance.
Standard selling price times the difference between actual units sold and budgeted units sold. Did we sell the quantity we expected?
Like Cascade Company, they sold more units than budgeted.
So favorable sales volume variance, good job on volume.
But they sold them at a lower price than planned.
Meaning an unfavorable sales price variance. Maybe they discounted to drive that volume.
Tells a story, doesn't it? Finally, what about when companies sell multiple products?
Ah, yes. Sales mix variance becomes important then. If you sell more of your lower margin products and less of your high margin ones, even if total units are on target,
Your overall profit might miss the mark.
exactly. Like the Neostar example. Total units were fine, but the mix shifted negatively, hurting the bottom line.
So wrapping this up, variance analysis is really about getting under the hood, isn't it?
Absolutely. It moves you beyond just, did we hit the number, to why or why not, across costs and sales.
It helps you understand the drivers. Material prices, labor efficiency, spending control, sales pricing.
And understanding these gives you, the listener, the power to ask much smarter questions. You can identify where things went right, where they went wrong, and where the focus should be for improvement.
It equips you better whether you're in management, an investor, or just trying to get a deeper understanding of business finance.
Okay, that concludes our deep dive on variance analysis. Hopefully it's clear now how this tool works and its value. And a final thought to leave you with. How might big, unexpected external shocks, think supply chain disruptions or sudden inflation, show up in these variances? And what could that reveal about a company's flexibility or vulnerability? Something to think about.